A very good afternoon and a very warm welcome to all. I am Richa Sachdeva. I work with NBC Advisors Pvt Limited as Head Corporate Trainings. NBC Advisors Pvt Limited happens to be one-stop shop for all kind of advisory services, be it accounts outsourcing, HR, or training outsourcing. We would be glad to assist you in case you're planning to set up your business inside or outside India. So today's session is on regulatory aspects in Singapore and compliances in India. We have Mr. Jason Liu, Director Entrust Public Accounting Corporation, who brings more than 18 years of audit and advisory experience with him, and Mr. Neeraj Bhagat, Director NBC Advisors Pvt Limited, who has rich experience in handling corporate affairs for more than 2 decades now. So we have both of them as keynote speakers for today's session. Before we start, I would like to mention that Singapore happens to be the most preferred destination for doing business. According to 2020 Doing Business Report, it ranks second. Now, few factors behind this are strong financial structure, its strategic location at the crossroads of shipping route, which makes it closer to major emerging markets across the globe, and of course, its low tax rates, which has made it a magnet for global finance. So to talk about this in detail, Jason will take it up from here. Over to you, Jason.
Good afternoon. Thank you for giving me this opportunity to share with you on the regulations of doing business in Singapore. I'm Jason Liu. I will give an overview of the main features of Singapore as a potential location for your business. Many of you would wonder why Singapore as an investment destination. Considering Singapore as a potential location for your business is a smart choice. Singapore was ranked as number 2 in the world for its ease of doing business by the World Bank. A quick glance of some boring but real facts based on the information from Department of Statistics Singapore. Singapore is a small tropical island of about 700 square kilometer with a population of close to 5.7 million. Singapore economy is heavily dependent on exports, with a particular focus on electronics, technology, and pharmaceutical. Although these sectors remain a cornerstone of the economy, the recent growth of financial services sector has been more notable. This is one of Singapore's most popular attractions, Merlion Park. Is located opposite of the Marina Bay Sands. So, will this photo convince you to live and invest in Singapore? Seriously, but why Singapore? Let me share with you. Singapore's strong market economy and its performance over the years has demonstrated internalization. Singapore, which is AAA rated, has more than US 1.9 trillion in assets under management and a market capitalization of US 751 billion. Singapore is politically stable since independence in 1965, provides businesses and investors a sense of assurance and continuity in its policies while responding promptly to market changes. Singapore has created ecosystem that support startups, with the most active being in the tech space. Some of the hottest verticals are e-commerce, transport and logistics, marketplace and platforms, real estate and fintech. Singapore has a robust and transparent legal system that forms the foundation for trust and confidence. Singapore has rigorous policies to protect intellectual properties such as patents, trademarks, copyrights, registered designs, trade secrets, and layout designs of integrated circuits. IP rights regime complies with trade-related aspects of intellectual property rights, known as TRIPS. investors can benefit from Singapore's extensive bilateral agreements. Singapore has various double taxation agreements and bilateral free trade agreements. Of course, not to mention, our personal income tax and corporate tax rate in Singapore are among the lowest in the world. To summarize, Singapore offers many outstanding advantages such as a highly qualified workforce, strategic locations in Asia, stable political environment, low tax rates, business-friendly legislation, significant investment initiative, world-class infrastructure, member of ASEAN, and a high quality of life. I believe by now you would wonder what are the regulations for investing in Singapore. Basically, an investor planning to establish a presence in Singapore needs to determine whether the proposed operations create a requirement to register with the Singapore authorities. Whether the intended operations create legal presence will be determined by reference to these specific activities and whether these activities can be interpreted as carry-on business in Singapore. A person is carrying on business in Singapore will have to register his business with the Accounting and Corporate Regulatory Authority of Singapore, known as ACRA. Singapore has no restriction on foreign investment of business. Take note that foreign investment in local banks and newspaper publishing companies is controlled. However, foreign investment in commercial, industrial, or retail properties is unrestricted, but certain restrictions are placed on foreigners acquiring lands. The repatriation of profits and the import of capital are freely allowed. No withholding tax on payments of dividends by Singaporean companies or repatriation of profits by branches. There are no control on currency exchange too. So what are the types of business structure available? Business activities may be carried out through a Singapore Incorporated Company, a branch registered under the Singapore Companies Act, sole proprietorship, partnership, limited partnership, or a limited liability partnership. A foreign company may also function in Singapore by establishing a representative office. Activities of a RO does not generally permit running of an operation in Singapore. In Singapore, LLC is the most common structure used by investors. A Singapore Incorporated Company is a separate legal entity created under the Companies Act, is able to own properties, enter contracts, sue and be sued in its own name. It is perpetual and any change of directors or transfer of shares will not affect its continuity. From a practical viewpoint, the limited company with share capital would be the type of company considered by a foreigner when investing in Singapore. Such a company may be either a private company or a public company. The most common form is the private company denoted by PTE Ltd. This refers to a company that has a maximum of 50 shareholders and does not have publicly traded shares. There are also non-private limited companies, such as public companies limited by shares, denoted by Ltd. These companies can have more than 50 shareholders, and their shares can be traded publicly, such as on a stock exchange. What about the legal requirement? A private company is easily identified by its name, which contains the word private or PTE. All companies have to include unique registration number known as UEN in their company's documents, such as letterheads. A Singapore Incorporated Company must hold AGM once every calendar year. Generally, each company should host its AGM within 6 months from its financial year end. and files its annual return within 7 months from its financial year end. Each company needs to appoint an auditor unless it is a dormant or a small company. How to incorporate a Singapore entity? Incorporating a private company in Singapore is a simple process. However, it should be noted that Singapore has a strict anti-money laundering regulations. Therefore, additional time is required for professional service providers to perform corresponding checks. In general, new company names are approved or rejected within an hour. A proposed company name will not be approved if it is identical to or resembles the name of an existing entity. Any undesirable names will also not be approved. An approved name will be reserved for 4 months from the date of application. The company should have a minimum of 1 director and 1 shareholder. At least 1 director must be a local resident director, in which Singapore citizen or person whose principal place of residence is in Singapore. He or she must be a natural person and above 18 years old. The number of shareholders of a private company is limited to 50, both individual and or corporation. The liability of the shareholder is limited to the shareholder's capital. Within 6 months from the date of incorporation, every company must appoint a secretary who must be a natural person and whose principal place of residence is Singapore. In the event that the same person acts as the sole director and sole shareholder, he or she cannot act as the company secretary at the same time. The minimum required paid-up capital is nominal, in which from $1. The concept of authorized capital no longer exists. It has been abolished. The company must have a registered office in Singapore, which must be open and accessible to the public during normal office hours. If you are engaging our firm, we will typically require these documents from you in order to prepare the necessary incorporation paperwork. Basically, we need the proof of identity such as NRIC and passport for individuals. For corporation, we need the certificate of incorporations and constitutions. All documents must be in English, else to be translated into English. After successfully incorporating your Singapore company, you can open a corporate bank account in any of the major banks in Singapore, such as HSBC, Standard Chartered, Citibank, DBS, OCBC, UOB, and etc. Service provider like us will prepare your new entity M&A and purchase of business profile from ACRA. This will be useful for a bank account opening and license application, if any. You may also need to apply 1 or more business license before you can commence your business operations. Business activities under these categories include restaurants, educational institutes, travel agencies, financial services, import-export related industries, etc. In Singapore, establishing a business is a relatively simple and straightforward procedure, and the business licensing procedure has been simplified to a great extent. If you provide all the necessary documents and comply with all other requirements, there is no reason for your license to be rejected. The ease of doing business aids in fostering Singapore's efficient and pro-business environment, making it a popular destination for new startups. If the projected annual revenue of your company exceeds 1 million, you need to register for the Goods and Service Tax, GST, which is also known as VAT, Value Added Tax, or sales tax in other countries. GST registered companies need to charge this GST, which is currently at 7%, to their clients on the goods and services provided. Every company must appoint auditors within 3 months from the date of incorporation, unless exempt from audit requirements. There was a new criteria introduced for audit exemption on 1st July 2015. A company qualifies as a small company and will be exempted from audit if it has been a private company in the financial year in question and meets at least 2 out of the 3 following quantitative criteria for the last 2 financial years. Number 1, total annual revenue less than 10 million. Number 2, total assets less than 10 million. Number 3, number of employees less than 50. In order for the company to qualify as a small company for a particular financial year, it needs to, firstly, be small for the 2 financial years preceding the current financial year. Once qualified, it will continue to be so until such time that it fails to meet the quantitative criteria for 2 consecutive years. What about tax compliance? A corporation is generally liable to Singapore income tax on all income accruing in or derived from Singapore, as well as foreign source income remitted or deemed remitted into Singapore. In Singapore, the chargeable income and the associated income tax are determined on a preceding year basis, known as year of assessment. A company is a tax resident in Singapore if the control and management of its business is exercised in Singapore. As a general rule, the place where the board of directors manage and control the company's business and holds board meetings is the place where the company is considered as a tax resident. All income derived from sources in Singapore and income from sources outside Singapore, if received in Singapore, are taxable. In case of double taxation of income, foreign tax credit can be claimed only by a Singapore tax resident, and the amount is limited to the lower of the foreign tax paid or the Singapore tax payable on that income. Foreign tax credit claims are governed by tax treaties and the domestic unilateral tax credit provisions. Remittance of foreign income in the form of dividends, branch profits, and service income into Singapore by companies resident in Singapore are tax exempt if the prescribed conditions are met. For remittance of specific foreign income that does not meet the prescribed conditions, companies may be granted tax exemption under specific scenarios or circumstances on an approval basis. There is no withholding tax on payments of dividends by Singaporean companies or repatriation of profits by branch. Dividends paid by a Singaporean tax resident company are exempt from income tax in the hands of shareholders, regardless of whether the dividends are paid out of tax income or tax-free gains. Unused trading losses may be carried forward indefinitely, subject to shareholding tax. Excess capital allowances can also be offset against other chargeable income of the same year and carried forward indefinitely, subject to shareholding tax, and the requirements that the trade giving rise to the capital allowances continues to be carried on, known as same trade test. In order to meet the shareholding test, the shareholders of the lost company must remain substantially 50% or more the same at the relevant comparison dates. If the shareholder of the lost company is itself another company, look-through provisions apply through the corporate chain to the final beneficial shareholders. Now, have a look at the various countries' corporate tax rate for an idea where Singapore stands. And you will agree with me that Singapore tax rate is considered one of the lowest in the world. Taxes in Singapore are relatively low because competitiveness is a key consideration of its policies. The prevailing standard corporate income tax rate is 17%. A partial tax exemption applies on chargeable income, excluding Singapore frank dividends up to 200,000. The chargeable income of a company for each financial year is based on the result of its financial year ended in the preceding fiscal year. Each year, the taxpayer must file a return to the Inland Revenue by 30th November. An estimated chargeable income, ECI, is to be filed within 3 months from the end of the financial year. For newly incorporated companies with tax residence in Singapore and has no more than 20 shareholders, of which at least one is an individual shareholder holding at least 10% of the shares, they will enjoy tax exemptions for the first 3 consecutive YAs as follows. 75% of the first 100,000 of chargeable income and 50% of the next 100,000 of chargeable income. The balance of chargeable income is subject to tax at the rate of 17%. However, this exemption is not available to property development companies or investment holding companies. These companies are given the partial tax exemption. Generally, all other companies will have their first 200,000 of their chargeable income to be partially exempt from tax. 75% of the first 10,000 of chargeable income and 50% of the next 190,000 of the chargeable income. The balance of chargeable income is subject to tax at the tax rate of 17%. A quick glance of the effective corporate tax rate for both scenarios, and you will love Singapore tax exemption. You pay no more than 8.5% tax on your first 200,000 taxable income and 17% thereafter. Let me walk you through this table. For new startup exemptions, the income tax rates will be charged as follows. The first 100,000 will be at 4.25%, followed by the next 100,000 will be at 8.5%. Thereafter, income above 200,000 will be at 17%. For partial exemption, the income tax rates will be charged as follows. The first 10,000 will be at 4.25%, followed by the next 190,000 will be at 8.5%. Thereafter, income above 200,000 will be at 17%. Transfer pricing is the pricing of goods, services, and intangibles within related parties. IRAS endorse the arm's length principles as the standard to guide transfer pricing, while taxpayer applies the arm's length principles when processing transactions with their related parties. They should also prepare TP documentation as evidence that the pricing is at arm's length. In Singapore, it is a must to maintain TP documentation for transactions which exceed certain thresholds and a revenue of 10 million. Singapore is part of the inclusive framework for the global implementation of base erosion and profit shifting, BEPS. GST is a tax-based domestic consumption. It's a form of value-added tax which applies to goods and services supplied in Singapore by businesses in Singapore and to goods and services imported into Singapore. Singapore currently has a 7% GST imposed on goods and services supplied in Singapore, as well as on importation of goods. A business is required to register for GST if its annual taxable supplies is 1 million or more. A GST registered business is required to file GST returns on a quarterly basis. From 1st January 2020 onwards, payment for digital services provided by non-resident entities to consumers in Singapore would be subjected to GST if both dates of payment and date of services performed is and on after 1st January 2020. Overseas supplies with a global turnover exceeding 1 million who supplies digital services to consumers in Singapore exceeding 100,000 are required to register for GST in Singapore. I hope you have gathered enough information to convince you to invest in Singapore. You can find our emails here if you need any clarification after this webinar. Our Entrust team can advise you throughout the process of establishing a business in Singapore, including business services such as accounting, payroll, corporate secretarial, taxation, and other recurring compliances. We look forward to welcoming you to Singapore. Thank you.
Thank you, Jason, for throwing light on this topic. And now, Mr. Bhagat, you can take it over.
So thanks, Jason, for the nice insight on investment in Singapore. Now I will throw some light on the compliances that need to be taken care in India. Now suppose somebody wants to decides that they want to invest into Singapore. So what are the compliances that need to be taken care from India point of view? I throw some light on it. So generally, when the compliances are to be made from India while remitting outside India, so these are called overseas direct investment, and these are there are regulations that are prescribed under FEMA guidelines. Now, what is an overseas direct investment? Now, suppose somebody opens a new company in India, and becomes a signatory to memorandum and articles of the Singapore entity. And when he or a company in India becomes a signatory, and when the remittance has to be made from India to Singapore, so then the ODA regulations have to be complied with. You have to see whether all the compliances and all the regulations that are prescribed as per the FEMA guidelines, they are met. Similarly, there could be a case that you want to buy an existing company in Singapore or any company outside India. Then when you purchase the shares of that foreign entity, then also you have to comply with ODA regulations. So that is also called an ODA investment, and you have to comply with the regulations that are in place in India. Now the ODA investment can be bifurcated into three parts. It can be an automatic route. In an automatic route, you don't need an approval from RBI, but the certain set of documents have to be given to the AD banker. AD banker will vet these documents. Once they are in order, then they will generate unique identification number online, and that once UIN number is generated, you get an email from RBI. And once that is done, then the AD banker will affect the remittance outside India, and that's how the investment is made under an automatic route. Now there are some guidelines wherein RBI reserves a right to approve these transactions, and then if as per these guidelines you fall under an automatic route, then you give the documents to the RBI, the AD bank. AD banker will overview these documents, give these documents to the RBI. Once RBI gives a confirmation that they are in order and they grant an approval, and then the AD bank will generate a UIN number. Again, you will get an email from an RBI. Then this is a process for an approval route. And basically, in a crux, you need an approval from RBI. Then only the funds can be remitted from India to outside India. Now, the RBI guidelines also prohibit certain activities which are not allowed, and you cannot remit outside India for doing business outside India. So prohibited activities, you are not allowed to do business in India. So they remain prohibited, and you are not allowed to do business. Now, while remitting outside India, what all entities are allowed to invest outside India? It could be a company, it could be a private limited company or a public limited company. It could be any body under an act of parliament, which could be a public sector company. It could be a registered partnership firm. Now, very important point to be noted is that registered partnership firm is allowed under automatic route to invest outside India. Whereas if it is an unregistered partnership firm, then you have to seek an approval from RBI. Then only you can invest outside India. Similarly, a limited liability partnership, it is also allowed to invest outside India. There are certain entities which are notified by RBI, they can also invest outside India. Similarly, the Indian residents, they are allowed under an LRS scheme to invest outside India up to $250,000. Post $250,000, you have to seek an approval from RBI. Then only you can invest outside India. Now the Indian party can invest as a joint venture partner outside India, or it can also open a wholly owned subsidiary in India. Now, when it comes to joint venture, it could be a joint venture between two Indian parties, or two overseas investors, or it could be one overseas investor, or one Indian party, or two Indian parties collectively investing into a joint venture outside India. So these are the combinations wherein you can invest outside India. We'll see what all sectors they are allowed to invest in sectors which are allowed in India to invest outside India. So as a general thumb rule, all the sectors they are allowed to invest outside India except real estate and banking. Now you have to see the definition of real estate. If somebody is into buying and selling of real estate or trading into transferable development rights, then it falls under a definition of real estate. And for a real estate investment, you need to seek an approval from RBI. Then only you can open a real estate trading company outside India. Now it's very important that real estate does not cover development of townships, construction of residential or commercial premises, roads or bridges. So if these activities have to be done outside India, then you don't need an approval from RBI, and it's allowed under an automatic route guidelines, and you can invest outside India under these regulations. Similarly, if one of the corporate they want to open an Indian bank outside India, that's not allowed, and only the Indian banks are allowed to invest outside India in a joint venture or a wholly owned subsidiary, that too under an automatic route. So you need an approval from RBI for a banker to open a bank outside India. Similarly, the real estate, if you want to do the real estate business outside India, you need to have an approval from RBI. Similarly, if there's an overseas joint venture of an Indian corporate and they start offering financial products which are linked to INR, then again you have to seek an approval from RBI, then only they can invest outside India. Now, there could be a case that, NBFC, which is into financial activities in India, they want to invest outside India. So besides the regulations which have been discussed in the previous slide, NBFC also has to comply with 4 more regulations. So they have to ensure that they have been profitable during last 3 years. They are registered as an NBFC with the RBI, then only they can invest outside India. Similarly, if they're looking to do financial services business outside India, they also have to ensure that they seek an approval from a regulatory authority in that country. Then only they can do NBFC business outside India. Besides that, they also have to comply with minimum capital norms in India, and then only they can invest. As per the current regulations, the NBFC ought to have a minimum capital of 2 crore rupees. Then only they can do the NBFC activities in India. And of course, if they want to expand outside India, then only they can expand outside India. Now, there could be a question whether the NBFC, which is into a financial services activities, they want to do a non-financial activities outside India. Do they need an approval form, or do they have to comply with these regulations? Yes. So NBFC doing a non-financial activities also has to ensure that all these the compliances are also done, or all these 4 requirements are also met. So then only they can invest into non-financial activities outside India. So I will give a broad overview of which all activities generally require an approval from RBI. Now the companies into energy and natural resource sector, if they are investing beyond the prescribed limit, then they have to seek an approval from RBI. Similarly, the Indian companies incorporating Indian companies in oil sector, investing into unincorporated bodies outside India, again have to seek an approval from RBI, then only they can invest outside India. Similarly, ODI by proprietorship concerns, as I discussed in previous slide, proprietorship concern is basically a one-man company. So the LRS scheme, they fall under an LRS scheme. In the LRS scheme, they are allowed to invest up to $250,000. Beyond $250,000, they have to seek an approval from RBI, then only they can invest. Similarly, unregistered partnership firms, they have to seek an approval, then only they can invest outside India. Now, all other forms of guarantee offered by the Indian party to its first and the subsequent level of step-down subsidiary would also require an approval of RBI. Similarly, if the Indian company gives a corporate guarantee to the second and the subsequent level of step-down subsidiary, again they have to seek an approval from RBI, then only they can give a guarantee outside India. Similarly, ODI by the registered trust societies in a joint venture or WS outside India would also require an approval from RBI. Similarly, at any point of time after investing outside India, you want to restructure the balance sheet of a joint venture or WS, which involves write-off of a capital or a receivables outside India. Then again, you have to seek an approval, then only you can write off the investment that is made outside India. Similarly, capitalization of exports remaining unrealized. Generally, you are given a time of 9 months to realize your export proceeds. If you fail to realize export proceeds within 9 months and you want to convert the sundry debtors for exports which are made outside India, then you have to seek an approval from RBI. Then only you can capitalize these export proceeds. But if it is within 9 months, the debtors are realized, the debtors are due within 9 months, and then you can convert that into share capital, and then you don't need an approval from RBI. Similarly, there could be countries wherein there is no share capital required, and you want to do some financial commitment in that country, and if there is no equity participation by the Indian corporate, in that case you need an approval from RBI for investing as a loan to the overseas subsidiary. Now we'll see what is the quantum of investment the Indian corporates are allowed to invest outside India. Before we come on a amount of investment, we'll see what all is covered under financial commitment. If an Indian corporate invests into an equity contribution or a preference shares in an overseas body, so that is part of a financial commitment. Similarly, if a loan granted by the Indian corporate to the overseas subsidiary is also covered under a financial commitment. Similarly, a guarantee given by the promoters of the Indian entity or by the sister concerns is also considered as a financial commitment. There could be a case that a banker in India gives a guarantee to the overseas subsidiary on behalf of the Indian corporate. 100% of that guarantee given by the bank is also covered under financial commitment. Now, there could be a case that the overseas subsidiary of the Indian company is guaranteed a project or any business by the overseas body, and they require a performance guarantee to be made. So the performance guarantee given by the Indian corporate, only 50% of that guarantee is counted as a financial commitment, not the 100%. Now, all this financial commitment that has been discussed in this slide, so 4 times of the net worth of the Indian corporate can be invested outside India. But this does not include if there is a balance in the exchange earners foreign currency account. So the money remitted from EFC account for a investment outside India does not cover under 4 times of the net worth, and you can, whatever is the balance in the EFC account, that can be used for making remittance outside India for overseas subsidiary. Similarly, if there are proceeds from a ADR or GDR issue, that can also be used for making a remittance outside India. So basically, in crux, the maximum financial commitment would be 4 times of the net worth plus the balance in the EFC account plus the proceeds from a ADR GDR proceeds. Now I'll throw some light on the loans and guarantees. So if there is an equity participation in an overseas subsidiary, then of course you can give a loan to the overseas subsidiary also. But if there is no equity participation in an overseas subsidiary and you want to give a loan to the subsidiary company, then you need to have an approval from RBI. Then only you can invest outside India via loan. Now the Indian party is also allowed to give a guarantee to the overseas subsidiary. So the guarantee can be by way of an Indian company giving a guarantee to the overseas body. It could also be a case that the promoters of the Indian company, they give a guarantee to the overseas body. Besides that, the sister companies or the group companies in India, they are also allowed to give a guarantee to the overseas body. There could also be a case that the bankers in India on behalf of an Indian corporate, they give a loan. So that guarantee is also covered and that is allowed as per the Indian regulations. Now, any guarantee that is given should not be an open-ended, and the time period of the guarantee and the amount of guarantee should be specified in the guarantee documents, and an open-ended guarantee is not allowed as per the FEMA guidelines. Now, besides the conditions that are required to be fulfilled, so there could be additional conditions that have to be taken care. Now, if the investment outside India is more than $1 billion in a fiscal year, then you need an approval from RBI. For less than $1 billion billion dollars, the guidelines in place should be met, and you don't need an approval if it is less than $1 billion US. Besides, the overseas joint venture should carry out only the bona fide activities as per the laws of the host country. So the overseas subsidiary should not indulge into any illegal activity which is not permitted as per the laws of their country. Similarly, the Indian party which is investing outside India, it should not be on the RBI's caution list, and it should not be under investigation by enforcement agencies, which could be a enforcement directorate or a CBI. Now, a fourth condition which is very important, all the transactions related to a joint venture or a WS should be routed through one branch of an AD bank. Now it becomes very relevant, when there are two joint venture partners investing from India, outside India, and if they're banking the different banks, then they have to ensure that they have a bank account in one branch of an AD bank, and all the transactions are routed through that branch only. The purpose of this is that to ensure that all the joint venture investment in a particular project outside India, and if there are different JV partners in India, so all the transactions are monitored by one AD branch, and the RBI doesn't have to ask for the questions from the different AD banks. So this must be considered very, very important. I have seen that a lot of clients, they make a investment from different banks, and at a later stage they have to file a compounding application with the RBI to get this compounded. Now, if there could be a case that the conditions for RBI are not fulfilled, then you have to seek an RBI permission for that. And generally, RBI, while granting a permission, they will see the financial viability of the joint venture. They will also see how it is going to contribute to the external trade. You will also see the expertise of the Indian party which is going to execute the project outside India. You will also see the financial standing of the Indian party. So based on all these parameters only, they will grant the approval, and then only the permission will be granted, and then you can invest outside India. We'll see some more regulations. Now, what are the sources from which the funds in India can be used for making remittance outside India? One is a simple market purchase. You approach the ID bank, they will see the current exchange rate. They will debit your Indian rupees and convert it into a foreign currency and make a remittance outside India. It could be swap of shares. A very, very important point is a swap of shares. Now, what happens is that suppose an Indian company invests into shares in a different overseas subsidiary, overseas company. The overseas company says that we don't want the funds towards the share capital and they want to invest into the shares of the Indian company. So that is also allowed under ODA regulations. But only thing that has to be taken care is that whenever there is a swap of shares, the valuation of the Indian company, valuation of the overseas entity has to be done by the merchant banker in India. So then only the ODA regulations are met, and then only you can invest into shares in an overseas body. Similarly, the capitalization of exports, as I discussed in the earlier slide, if it is within 9 months, the exports are within 9 months, then you can capitalize these exports and you don't need a permission. And if it is more than 9 months, you need to have a permission from RBI. Similarly, in the exchange of an ADR GDR issues, the company which is subscribing to the ADR GDR issues of the Indian company, so there could be an arrangement wherein the ADR and GDR are issued to the overseas body, and instead of getting the money from the overseas bank or overseas deposit participant, the Indian company gets the shares of that overseas body. So that is also allowed, and wherein you can hold the shares of the overseas body and in turn issue the ADR and GDR of the Indian entity. Similarly, the balances held in EFC account can be used for making an overseas investment. Proceeds of the ADR or GDR issue can also be used for making an investment outside India. Now we'll throw some light on the step-down subsidiary. There is no restriction as such on opening a step-down subsidiary of a foreign company. Similarly, if the step-down subsidiary wants to do a financial sector activities, then they have to comply with 4 additional guidelines for the financial services activities, which have been discussed in previous slides. Similarly, a very important point is that when there is a subsidiary outside India, it cannot open another step-down subsidiary which has a subsidiary in India. I'll give an example. Now, suppose there's a company A which has opened a subsidiary B in Singapore. Now, company B wants to open a subsidiary C in India. So that is not allowed under regular guidelines. If from case-to-case basis, you have to approach RBI and then only you can seek an approval from RBI. Then only you can open a step-down subsidiary in India. The reason why it is not allowed is that it involves a reverse stripping. The money going from India to outside India, again coming back into India. So that is basically reverse stripping. And if that has to happen, you need to have an approval from RBI, and RBI will see on case-to-case basis. Then only they will grant an approval. Now there could be cases wherein you acquire the stake in a foreign investment, foreign shares, without the money going out of India. There could be cases like there is a relative of yours who's holding the shares outside India, and due to a gift or an inheritance, you get these shares. Gift or inheritance is allowed. You don't need an approval from RBI. Similarly, there could be a person in India, employee in India, who's working with a foreign company and who's allotted shares. Again, he doesn't need a permission from RBI. He can hold these shares. Similarly, there could be an employee of an Indian foreign subsidiary, which has a foreign company which has a subsidiary in India. And as per the ESOP policy of the Indian subsidiary, the employee in India can be granted shares of the foreign parent. So that is also allowed. And in all these cases, you have to intimate RBI within 30 days of the shares being allotted to you. Now, very important point I would like to elaborate. Now, some countries like US and in Australia, you can open a company without making an investment outside India. Now, suppose you are allotted shares, but there is no requirement to invest outside India. So if you become a beneficiary of a shares without these 4 conditions, like without inheritance, without gift, without ESOP policy, and you are allotted a shares, then you need to have a permission from RBI. Then only you can hold these shares. And a lot of corporates, they make a mistake. They open a subsidiary. They say that we have not invested outside India. Why we are not made any payment from India to outside India? But regulations in India say that you need to permission from RBI. Then only you can hold these shares. You see, what happens is that when you hold these shares and at a later stage subsidiary does well, and you bring the money as a dividend or as a repatriation of technical fee, And when the money hits the bank account, then the banker will ask questions. And at that stage, you have to approach RBI, seek for the compounding, then only it can be regularized. So this is very important. Any investment made without consideration, you should have an approval from RBI. Then only you should invest in these companies. Now I will throw some light on the annual compliance that needs to be taken care. On an initial investment, when you decide to invest outside India, you have to give a documentation in form ODI to the banker, along with a copy of the board resolution, the form A2, the statutory auditor certificate, valuation report for the value of the shares of the overseas body. Once all these documents are there, the banker will vet these documents. Then, once they are in order, they will generate the UIN number and then affect the remittance. Similarly, there could be a case that you have opened already a subsidiary outside India, and the company outside India opens another subsidiary in that country. Then you have to intimate the RBI within 30 days that there is a step-down subsidiary of that company. Similarly, if you have opened a joint venture outside India and there is change in the shareholding outside India, again you have to intimate RBI on any subsequent changes in the overseas subsidiary. Besides that, you have to ensure that all the dividend, royalty, technical fee, which is due from the overseas company, is received in India within 60 days of it becoming due. Now, I will give some information about the annual filing, which generally people ignore after investing outside India. So, as per the law, as per the FINMA regulations, every company which has done the ODI outside India, they are required to file an annual performance report in part 2 of the form ADI by 31st December each year. And then they also have to file the copy of the audited accounts of the overseas company. And if the law of the country says that you don't have to have an audit in that country, then the unaudited accounts which are approved by the Indian Board of Directors and certified by the statutory auditors of the Indian company, they have to be submitted to the AD bank. And once that is done, then that compliance needs to be taken care of on an annual basis. Similarly, the annual return on the foreign assets and liabilities has to be done online. It has to be filed online with an RBI by 15th July every year. So these compliances must be taken care, otherwise there's a penalty involved on the non-compliance. So as I already discussed that you can acquire the shares by a gift or inheritance, the report has to be made within 30 days. So again, the ESOP issued to the employee of the Indian company is a format which has to be, there's a format for that. The reporting has to be made in this format to the RBI within 30 days of the shares being allotted. So this is from my side. Any questions from your side, from Jason, from me, and we would be happy to answer.
Yes, so we have a question from, one second. Yeah, so we have a question from Mr. M.N. Vyas. What is the tax rate for individuals? So Mr. Vyas, can you hear me?
So this is for Singapore or for India?
Or probably I answer on behalf of Singapore.
Yeah, please.
Okay, Singapore tax rate is basically based on your progressive income. So they start from something about 20,000 or below. There's tax-free, not tax-free. Means there's no tax, or as and when we stage out, higher percentage and so on, up to 22%. There is multiple levels. John.
Hello, thank you. I think I'm just asking whether when we give dividend on the foreign company, what are the tax rate? An individual getting dividend from Singapore company.
Like what I mentioned in the slides, technically any dividend from Singapore to the shareholders are tax exempt. There will be not any tax when there is a dividend or even a repatriation of profit by a branch.
Okay. So, Rishabh, do you have any other questions?
Not as of now, sir.
Okay.
Yeah, so we have a question from Mr. Dinesh Tiwari. And let me just unmute him first. 1 second.
Yes. Can you hear me?
Yeah, we can hear you.
Yeah, I wanted to just check as an angel investor, if an Indian investor makes an investment in a Singapore company and he holds less than say 5% or 10% shares because he's a financial investor, do the annual compliance to the RBI, you did mention that the annual compliance you are required to provide the annual accounts of the company, which is there. Is there a threshold of the ownership levels for which it is required? If I'm a 1% shareholder, for example, I may not get access to those data, right?
You see, that will depend, ultimately if you're holding 1% stake and, you are investing as not as for controlling the affairs or doing business, and you are holding it only for making an investment outside India. But if the investment is less than 250,000 US dollars, then it will fall under LRS scheme. So if it is under an LRS scheme, then you don't need a permission from RBI, and then you invest under a LRS scheme. If it is an LRS scheme, then you don't follow the ODA regulations and you don't have to give an APR. But if it is investment is more than 250,000 US dollars, then the banker which is making an investment outside remittance outside India, they will ask for all the documents of the foreign company, and then if you can get an access to the foreign company documents, then of course you can get a financial audit, balance sheet, and all the documents at the end of the year also. So that will depend, how much amount of investment you are making as an investor outside India.
Sure. Thank you. Thank you very much.
Thank you. Thank you.
All right. If there's any other question, you can please ask the keynote speakers right now, and we'll be happy to answer that for you. Okay, so we have a question. No, so that's an appreciation. Thank you, Mr. Sachdeva. Thank you so much. So he's thanking all of us for putting in great effort.
Thanks everybody for taking your time and hearing us. And if any questions, you can always email us and we'll be happy to answer them.
Thank you, everyone.
All right, then we'll wrap it up here. Thank you all for attending this session. And we're always there to help you. So please drop us an email in case you have any doubt or any clarification regarding the content that we shared today.
Thank you. Thanks, everybody.
Thank you, people.
Thank you.